Despite an attempt to hit a new high, the market situation remained unchanged. Oil prices came under pressure from a surprise built in U.S. crude oil inventories. It's a change in the U.S. crude oil stockpiles that is now the key factor determining the direction of the oil market amid Saudi Arabia and Russia's supply cuts. Also, it's worth taking into account the risk of sentiment dominating the market in anticipation of today's meeting of the U.S. Central Bank, which is expected to end in another interest rate hike. This event may well overshadow the release of statistics from the United States Energy Department. So, until next week, or until some news driving supply and demand comes out, oil is likely to keep trading in the range of $83 to $78 per barrel. For gold, today's Fed meeting is of paramount importance, judging by the way the asset tried to dive to $1,940 per ounce before rebounding to the $1,960 area. Investors are reluctant to put in more cash. After all, even if the U.S. Central Bank signals opposing a monetary policy tightening, the very fact of another interest rate hike will still have a negative impact on the metal. And in this case, U.S. Treasury yields will edge higher, with a part of the capital flowing into the debt market from other safe haven assets, including gold. Of course, if the U.S. regulator announces that no more rate increases are ahead, gold may gain a bit, but then still resume weakness. Speaking of the Russian market, Bank of Russia data showed yesterday that the country's current account surplus narrowed sharply to $5.4 billion in the second quarter of 2023, marking the worst result in recent years. In theory, this should have led to a weaker ruble, but the Russian currency remained stable. Analysts skeptical about the ruble are now justifying their failed prediction, suggesting the asset's collapse by claiming that the market has already priced in a sharp drop in Russia's current account surplus. However, the best explanation may be more detailed information on the balance sheet, namely data on the movement of a capital, the deficit of which amounted to only $100 million. Notably, this is the smallest outflow of a capital since the start of Russia's special military operation. In other words, the outflow of capital, which is quite logical in the face of sanctions, has almost ceased. Consequently, financial risks associated with this factor have diminished considerably, and the financial system itself has been able to address this problem. This inspires optimism and paves the way for the ruble's gradual recovery. Thus, the dollar may well slide to 85 rubles in the medium term. And that's all for now. We wish you profitable deals. See our channel with a new video in a couple of hours.